Lesson number 8, the 220 double moving average trade. In lesson 8, you will learn how to trade using the 2200 double moving average indicator on the 512 tick chart with a low risk, high reward trade setup. Okay, so to install the double moving average line, you should have the code supplied with these videos. Okay, all you'll want to do is save it and then go to Studies, Edit Studies. Okay, and then I actually have mine called the double moving average line. You'll want to apply it, okay, put it up in your strategies, and then for your settings, you'll want to change it so it'll be 0, 20 for the moving average length 1. Moving average length 2 will be 200. You'll then want to go to close, okay, for price. Moving average type 1 will be exponential, and then moving average type 2 will be variable. It has to be these, okay, for it to work correctly. This is what I use. I played around with it for a long time trying to see what works best. This is the one that works best with the time frame, okay, of the 512 tick chart. Select OK, apply, and now you have it. It's this line, okay? What happens is when price moves, okay, through it, and the 20 and the 200 moving average lines actually cross, it's going to give a signal. Okay, so there are times where price will go above it, okay, but the color's still blue. Okay, blue's bullish, red is bearish. Okay, that's the way I have it set up. So there are times where price will actually break down or above, but the key is to let price fall, and then you're actually able to enter one candle beyond when the line changes a different color. Okay, so as you can see, blue on this candle was probably still blue, and then when this candle opened, it turned to red. Okay, so you would enter on this candle, the low of this candle right here, okay, and you would just put your stop either above maybe a recent swing high, or wait till for price to actually change color, okay, on that candle. Usually it's within a couple points, okay, maybe a 1.5. It's not actually that much of a move to where it changes. But look at this, right? You could have gone short, we'll say at the 60, we'll just say 61.25, okay? It fell all the way down to 55. And as we kind of go through, you'll see where price will come back up, touch it, okay? Price rallies, touches it, and then falls back over again. Okay? Now, there are times where price will actually get choppy, right? So right here. So right here, you are still red, and then it turned blue on this candle. So let's say you got long here, okay? You would have gone long probably right around the 56 level, but then it turned red for a brief second on this candle, which was around the 53 level. So you had about 3 points worth of risk, right? But then went to blue real quick, red, and then the red fell again, right? And look at this. You come back, you retest, and you fall back down. Okay, so there's a few different ways you can actually trade this. You can look for when price pulls back, the very first touch, okay, after it's pulled back, to either get long or short. That's one of my favorite trades. I like to wait for price to get overextended, then rally all the way back. It's usually going to act as a resistance level on the very first touch. Here, it almost touched it. Okay, sometimes it'll come a tick or two, maybe a point away. Other times it'll go through it by a point and then reverse and go low, right? So what I look for is I'll tie this in with the RSI, right? If I see something like this where I have divergence going on with price, as price is rising, but RSI is diverging, now this is going to become a lot more of a high probability trade that's going to work in my favor. Okay, those are the type of trades that I look for. So when it gets up there, I'm just going to put the order in. No, and my stop loss is when price goes through and it turns blue. If it doesn't, I ride the trend lower. So let's take a look at a couple more examples, okay? We come down, very first touch, look at this, right? Touches it to the tick and then pulls back. Again, these could be trend trades. If you think, hey, the market's going to keep going lower, the bigger picture's potentially lower, right? We're just in the bounce and you're getting short for the trend lower. Or they could be smash and grab trades where you're looking for a quick in and out entry, right? You're looking for 1 or 2 points. So then right here, look at this. Price actually rallies. We get blue and it's off to the races, right? So you actually never really took that much heat because you probably got long right on this candle right here. Is this candle was the one that turned blue? Okay, you never really took heat on this entire trade. And there's a lot of times you could get some very nice trending trades off this, right? Right here, you pull back, bounce off, and then rally. Pull back. Remember I said the very first touch, you want to look to be a buyer. Rally, pull back, touch, be a buyer. Be a buyer, right? And then we kind of break through, and now we're on the other side of it. Here, we rally, or sorry, we fail, okay? We're starting to go lower with a red double moving average line. Price reverses, very first touch, go short, okay? So, and of course, there will be times where it gets choppy, like inside here or inside here. But again, this is where you potentially look for patterns, right? Look for RSI divergence. Okay, do you really want to get short? Even though it's showing you red, do you want to get short with this RSI divergence? Probably not. But if you did, okay, you would say, hey, I'm going to get short. We'll say right here at 49. Well, up here, probably 52 was your exit when it turned blue. You only had 3 points worth of risk, and it saved you a lot of heartache, right? Because look at what the market did. So now, if price comes all the way back down to this 1960 level, 61, what do you want to do? You want to be a buyer. Have a resting order in at 61, okay? And these types of trades, I like to give them maybe 2 points worth of risk versus maybe letting it change color, or it depends on market conditions. I'll actually wait for the signal for it to change color. But again, kind of going back, use your RSI, look for divergence, right? If we pull back and we actually have a higher low, okay, in the RSI, now we have divergences. Price is making a low, but RSI might be making a higher low. I might like this trade a lot more for the bounce to the upside. Also, look to the left of the chart, right? Hey, we know we actually have a support level right here, right? We've pulled back, bounced, rallied. So if we come down, now we have the 2200 double moving average with a support level. So maybe price will break through by a point. Maybe try and get a little better entry by putting an order in at 60 and a quarter, and your stop loss would go right below this swing low right here. So those are a couple different strategies for trading the double moving average. Again, that's the 2200 double moving average. I love this for scalp trades where you look for 1 or 2 points, or look for trending trades too. Okay, yeah, you will. If you take every single one, you will come out a lot better. But the problem is where do you take profits? Do you let it run 5 points, 10 points? Okay, sometimes you'll get it, sometimes you won't. But that's where you can also use a trailing stop and just trail your stop, right? This would have been perfect on the blue. Trail, 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 right? Maybe you never got stopped out until up here. And you could have collected a nice 10-point gain, okay, with only about 2 or 3 risk reward, okay, risking 2 or 3 points to the downside. So I hope that helps with how to use and trade using the 2200 double moving average line. Coming up next, lesson 9.